Are you ready to dive into the mind of a man who's transforming real estate, investing with a $206 million portfolio? He's known as the fixed income GOAT. Nic DeAngelo has been hailed by top podcasters for his razor sharp insight, his ability to simplify the complex world of economics and real estate. If you're looking to decode the future of fixed income and real estate, you are in the right place. Well, I want to welcome you to another powerful episode of Power Your Profit podcast, where we bring the brightest minds in business and investing. Today, we're honored to have Nic DeAngelo, the CEO, founder of SAIT Investment Group. Nic has built a real estate empire by fusing economic foresight with unparalleled understanding of the market. With a portfolio spanning 20 states, 24 projects, over 500 loans, Nic is here to share his journey, his philosophy that Wall Street is broken and real estate is the cure, and the strategies that have made him a sought-after voice in the investment world. So whether you're a seasoned investor or just getting started, get ready for an episode packed with actionable insights and thought-provoking discussions.
Welcome to Power Your Profits podcast, your friendly guide in bringing your business revenue to the next level. Listen as host Dr. Susie Carder hears inspiring stories of success from her fellow entrepreneurs and transformational leaders. Prepare to make significant change to your strategies as they unravel the secrets of building multi-million-dollar businesses and the most effective tips on finance, marketing, and sales accountability. If you want to take your first steps towards explosive business growth, this podcast is for you. Without further ado, here is your host, Dr. Susie.
Nic, I'm so excited to have this conversation because this has been, one of my wealth strategies for 25 years. And I figured it out on my own. I didn't have a Nic, right? Everybody needs a Nic to go. Am I doing it right? Lost my ass. I will say I did lose my ass because I didn't have a Nic. So why don't you tell our audience, really, I've got them excited to listen to you, but in your own words, like what's your jam? What's your secret sauce? Kind of share what you're going to share today with us.
Absolutely. So Susie, it's great to be here. Great catching up with you beforehand. And I'm excited to, I was looking forward to the show. So a little bit about me. My name's Nic DeAngelo. I'm with SAIT Investment Group. My background is literally an entire career of investing and entrepreneurship. So built and sold 3 companies over the course of the career. And then I jumped in very, very, very early. My first foray into full-time real estate was with some family offices. Smaller family offices. My goal was to link up directly with the CEOs, but I learned multi-generational wealth strategies, investment strategies directly from guys that were doing this on a very large scale. Again, multi-generational, which is a multi-decade approach. So I look at real estate the same. Real estate's my number one, without question, my number one vehicle that I choose and focus on for building wealth. I think the entrepreneur mindset and building companies and all that goes 100% in line with that as well. And both are passions of mine for really my entire life.
I love that. And so let's talk about, right, you've got some foundational beliefs about it. So let's talk about the 2 foundational beliefs that you believe inside of building wealth.
Absolutely. So without a question, the 2 most impactful ideas that I think apply today in this market environment that we're dealing with is that Wall Street has a lot of question marks right now. I would go so far as to say as the foundation of Wall Street that we used to invest on, right, me included, is broken as it used to stand. I still think there's opportunities. I don't want to poo-poo on my friends that are on the Wall Street side and doing a lot of the stock side, but that system has changed fundamentally, right? If you look at just the stock market since 1995, the number of companies has reduced by over 40%. Okay. So the stock market has grown by a dollar basis, but there's also things like inflation in there. There's also things like the top, handful of companies, dozen companies absorb such a disproportionate amount of value from the market, but the total number of companies has reduced by over 40%. That scares me significantly. right? I'm not in the room. Go
Why
ahead,
does
go
it
ahead, go ahead.
scare you? Why does it scare you? And what does that mean for us lay people?
For a number of reasons. One is that the stock market has this huge advantage historically where we as an investor group, we as an investment community have the ability to buy into great companies that are doing great things. And, you can buy one share or 1,000 shares or 1,000,000 shares. It's kind of like a great equal opportunity. The difference with the stock market today is truly the best opportunities, in my opinion, are no longer public. They're private.
Right.
Okay.
Right.
And so that's why it's called private equity, right? It's those dollars that are taken out of public markets and are moved towards private investment opportunities. So while the stock market has reduced by 40% in number of companies, private equity and private ownership in companies has boomed. The
Mm.
returns have skyrocketed, right? These private investment opportunities. So on my side, I look at things like REITs, which are the public real estate investment trust, the things that people can invest in that are more public facing and easier to access, et cetera. Those are great. There are some advantages, but I just don't see them as competitive in the marketplace when you drill down on things like returns, investment strategies, long-term sustainability, stability. Half the point of, a huge point of real estate is to offset other opportunities that you're doing or taking or, tax things. It's an offset. It's a strategy for long-term wealth building. So if you look at things like real estate investment trusts, like REITs, they're almost in line with the stock market. So
Right.
you might as well just invest in the S&P 500 or something. It's not really as pure of a real estate investment. So
Right.
that's I think Wall Street is broken as it stands today. I'm not putting money that direction, although I do have stock investments historically. And then I think that the best way to look at investing today, there's more opportunity than we've ever seen since 2008 right now today, but you really have to drill down into the data. So those are the two focus points that I have today.
And so what data should we be looking at to make sure what we're doing is the right investment for us, right? So there's not a right investment, right? It's what you're comfortable with. But let's talk about what data we should be looking at or being counseled on. What should
Absolutely.
we
So,
know?
so what I'm looking at, we were just going through it this morning, on our team call, on our asset management call. We have about 10 pages of notes on economic highlights and data points and things that we look at. But if you want to oversimplify it down to just a few things, I'll give you those right now. The first is, what the heck is happening with rates? Okay.
Yes. What is
What is,
happening?
yeah, I'll jump right in. So the first question is, what's happening with rates? And what's happening with rates is that, again, we talked about Wall Street having big question marks, some big concerns. Wall Street has been historically the last year, 2 years, 100% wrong on rates. Okay.
Yeah.
What's actually happening with rates is that the Federal Reserve is trying to figure out the real inflationary pressures and how significant those are. So if you back up all the way to 2020, when inflation was 1.4%, we had Janet Yellen coming out, the Federal Reserve chair, or former Federal Reserve chair, saying inflation's transitory. Don't worry about it. It's going to come and go. It's going to go by. Not long after, so about a year and a half later, inflation was at 9.1.
Right.
Susie, that's the worst we've seen in, 40 years,
Right.
right? So the Fed was way off even. So now you fast forward to today, it's bouncing around 3%, which the Federal Reserve's target is 2%. So that's what's going on with inflation. They're targeting 2%. We've had the highest, steepest increase in rates in a short period of time. Not the highest rates we've ever had, right? But the highest increase, the highest acceleration of rates, increase in rates. And now where we're sitting today is a big question mark of what happens. They've successfully slowed the market down. We're now seeing employment numbers that are starting to falter and change and go the wrong way, which is good for the Federal Reserve because that means that inflation's probably going to peel back. But what we know for certain is whatever they do with rates, they're not 100% on their shots. They're not hitting the bullseye every time. So what's likely ahead is that we'll have rate reductions coming up in the future. Will that fix inflation? I don't know, because what we're looking at is still inflationary pressures that are 3% instead of 2%. That's 50% higher than they're targeting. So we
Right.
have this higher inflation environment. The market's getting worse. So they want to drop rates, but it's still not resolved, which creates a lot of uncertainty for businesses and investors.
Juicy, juicy, juicy.
Yeah, a little bit of
So,
everything.
and is that how you look at your data-driven approach, right, to investing? What are you looking at to decide this is worth my investment? Do you have a formula? Do you have a spreadsheet? We're spreadsheet geeks over here. We love our spreadsheets.
So
Like,
we're actually,
no, like there's the
so yeah,
guesstimate, right? Like we were talking about, we both live in California and that's
yeah.
always been a great investment, but it's been really kind of this, hope and a prayer. But let's hope this works. It's always worked until it doesn't, right?
Yep.
I've definitely lost my hiney. So let's talk about that. What data are you looking for when you're evaluating real estate?
So here's the good news. We're actually literally releasing our exact sheet. We are releasing our economic spreadsheet of exactly what we're looking for. So people can check our website and check that out. And Susie, that will give you exactly what we're looking at. But to give you an idea on the real estate side, what we're looking at, it's the difference between the markets and the assets that we like. We're all commercial. As far as our syndications, we're 100% commercial, primarily focusing on industrial real estate. So we like it because it's long-term stable. The leases and the tenants that we work with are usually multinational or huge companies, 9-figure companies. So it's very, very stabilized. The issue is with the current rate situation, rates high, and then the current price situation, price high, there's just not enough room for returns.
Right.
So what we found in the market, like you said, you lost some money in real estate. Right now, the most real estate does not have enough return, enough meat on the bone to make sense for investors. So
Right.
what we've leaned into in this market, so that's just the return's not really there. The risk profile's too high. Those are the things we look on the data side. What we've leaned into with our investor base being a little bit older, our investors being a little more sophisticated, a little bit higher net worth, they've been asking for something different than we've seen historically. And the biggest shift in investors that we've seen is them looking for very stabilized, very consistent real estate fixed returns. That's a big shift, right? Historically, it was how much can we make? Can we do, the biggest returns possible? And we did that. We've had historic IRRs of over 35%, historic, annual returns of over 35%. Now we've leaned into the fixed income side. So we've been looking for stabilized, at what real estate assets have 10 to 20 years of really, really stable returns. And what we found that the data pointed us to, it was mortgages on single family homes.
You're listening to another episode of Power Your Profits podcast. We'll be right back after a quick word from our sponsors. Overwhelmed by the complexity of business profit strategies? Jump aboard the Bullet Train to Big Profits course, a streamlined solution by Dr. Susie Carder. This course is designed to uncomplicate the path to profitability. Imagine being able to identify and execute profit strategies with ease, skyrocketing your revenues. Visit course.poweryourprofits.com and sign up for the Bullet Train to Big Profits course today. Are you tired of struggling to take your business to the next level? Power Your Profits is the game-changing book you've been waiting for. Dr. Susie Carder, creator of the Predictable Success Method, reveals her proven strategies for explosive growth. From daily operations to marketing systems, this comprehensive guide empowers you to achieve predictable revenue and profit growth. Don't miss out on this invaluable wisdom. Transform your business today. Find your copy at books.poweryourprofits.com.
Say more about that.
Sure.
Got my attention. Say more about that.
Absolutely. Yeah, I could go on forever. I geek out on all this economic stuff. But in the market we're in right now, Susie, you and I can't even have confident conversations on what the Fed's going to do next month with rates.
Right.
Right. So that's the market we're in. And again, Wall Street at the end of 2023 was betting in 6 rate cuts in 2024. There's been 0 so far.
Right.
So that's where markets are at outside of this. So we were looking for assets where we could say, well, what could we bet on for 10 to 20 years? The only thing we found in the real estate sector was mortgages, because the US has this really weird mortgage structure. The
Yeah.
rest of the world does not do it this way. But the US, 98% of mortgages are fixed rate mortgages, and the vast majority are 30-year terms, right? Most of the world doesn't do it that way. So we found that highly stabilized. And when you really dig into it, you look at like the baby boomer generation, no
Yep.
plans to move for 10 to 20 years. They control 43% of the market already, right? You look at
Right.
government loans or government insured loans or another 20% of the mortgage market. I mean, there's stacks and stacks and stacks of data on top of that, but it's such a rock solid comparatively. So it's such a solidified investment opportunity today that other pieces of real estate don't have. The stock market certainly doesn't have. We lost 9% in a couple of weeks in the stock market in the last couple of weeks. So that's what we've leaned into. That's what our investors have asked us for. And that's what we've seen the data been pushing towards, is going into that section of the market.
So then you're buying mortgages. Is that what I understand?
Correct.
Okay,
Correct.
got it.
We've leaned into it, a fixed income fund. So we
Yeah.
pay our investors a fixed amount because, like your audience, very entrepreneurial minded people.
Yeah.
Sometimes you have businesses with highs and lows, or sometimes you're moving towards retirement and you just want to know exactly what you're getting in the mail every month, check wise. So that's what we've
Exactly.
leaned into, is to pick up that space in the market, because most people don't have access to that right now.
And so then what's the first step? Because I think this is a juicy opportunity, because you're really managing right? I'm making the money as the entrepreneur. I invest with you, then you're managing it. So what would be that first step to work with you? I know you have to be a accredited investor, correct?
Correct. Yeah, the SEC limits us to only, individuals that are making, 250,000 or more, or a net worth of over $1 million. That's their criteria for an accredited investor. But on the flip side is we get to work with really amazing people, a lot of high net worths, in the nine figures. So
Yeah.
it's been a great great group of investors.
So when you talk about, in your bio, it says you're the fixed income GOAT in real estate circles. So explain what that means and how do we leverage that?
So at the end of the day, our investors were asking for, something in the fixed income realm. But at the same time, they could go to the bank and get CDs, or go get, other fixed income products at the 5-6% range if they're lucky, right? For
Right.
returns. So we offer 12 to 14%. And so it's a good clip higher than what people are getting other places. And where we fit into people's portfolios, where we seem to add the best value, is people that are in the, shift to retirement, saying, hey, I actually want to deleverage from the stock market. You look at like Investor Business Daily, like big publications on the investor side, they're recommending a 20 to 40% reduction in stock holdings, right? So
Right.
we are just positioned as, a huge opportunity to offset risk a lot of other places with a fixed return. The other side that we see is really successful. My background being on the entrepreneur side, what I saw was a very successful business. We were making good money, but it was so seasonal. It was super lumpy. So we'd be having these massive months with huge margins. And then we had other months that were very, very, it was feast or famine. And what ended up happening was I was shoveling money towards real estate, saying, I can't do the roller coaster on this. I need some stabilized income. So that, demographic, people that are, on the business side or want to offset income with something more stable, those are kind of the two biggest. High net worth, move into the retirement years and want kind of stabilized income, or someone that is trying to offset their income or invest in something that has a high return that will send them a check every month. Those are kind of the two most common, although, we have infinite case studies of investors we see.
And then is the fund secured by something? So, when you go to a bank, you're getting that 5%, but it is secure. Stock market is not, right? So
Sure.
talk about that a little bit so that people can see, oh, I want that 12, 15%, but how are the funds protected?
Sure. We have over 500 mortgages that back up the fund. So there's a lot of assets that back it up, but to be 100% clear, it is not FDIC insured, right?
Right.
So a bank, hey, 5% ish, FDIC insured on certain investments. Other investments, they're not FDIC insured, but we are not FDIC insured. This is a private, private offering basically. So it doesn't have the same, government insurance that something that pays 3 or 4% would have.
So then how do you balance the risk and reward in your investment portfolio, especially today, right? Because you're speaking our language, like
Sure.
we're all exhausted of the stock and going, do I leave it? Do I,
Me too.
That old school where you're like, don't touch it, don't touch it. You're like, I don't know if I don't touch it right now because it's really scary.
Yeah.
And I
I
am
would.
a little more seasoned than you, Nick. I just want to say, so I am that ideal client that's, I'm not retired yet. I've got another 10 years or so before I do that.
Sure.
But still, you're like planning. Your risk level is lower because you're like, I want a little more security, right? We built this nest egg. So how do you protect it? But then also, how do you leverage it?
Sure. So I'll put it this way. There's a few boxes I, as an investor, would check. And by the way, I invest 6 figures every single year, multiple 6 figures with competitors all the time, right? And the real estate space is very, it's co-opetition, right? Everybody kind of working together, there's deals and there's operators that we don't operate in that space, but I love what they're doing. So I'm giving them money and investing. So I get to see what a lot of the top operators are doing, whether they're direct competitors or indirect competitors. This is what I would look for right now. The first thing is, are they paying their bills? Have they missed any distributions? That's very common in real estate. By the way, it's common with many companies right now, but the real estate space, it's cyclical in a big way. So right now, even the safest investments historically, like multifamily, have some question marks there too, where there's corrections, there's refinancing debt to higher levels, and that takes away some cash flow. I would say on our side, confidently, we've never missed a distribution to investors. That's the point of the income fund, is to not have those problems. The reason for that is because we have on-time payments for our mortgages that back up the fund that are at north of 96%. I think it's 96.7% on-time payments. And the reason for that is we buy really conservatively. Again, an income fund is not to squeeze out every penny of returns. We do not want to hit 30% returns. The goal is that it's very conservative profile of deals. So, really our strike zone is around 55% loan to value, meaning the homeowner owns almost half of the value in that house. That's extremely conservative. So on $1 million home, they have $450,000 in equity, right? So they're not moving anywhere anytime soon. They want to stay. They want to be very friendly with their lender, which is us in many cases. And, we work with homeowners to make sure that they have a long track record and long road ahead of success in their home.
Juicy, juicy. I was trying to find some dirt on you right before we started, just, because you want to know it's people's money.
Absolutely.
Which is good. I couldn't find dirt, y'all. And I dug for some dirt,
Good. Good. I'm in. If there's any fun, juicy stuff, I'm in. I like fun conversations.
But because it's money, and you want to make sure that you're working with people who've been there, done that. They're the real deal. There's so many people in our industry that are charlatans. They can talk about doing it, but then when the rubber meets the road, they're not doing it.
Yep.
So I think that's important to me, bringing anyone on our show, bringing anyone to our tribe and our community, right? Because they trust me, and it's important that we trust you to make all that work and make that happen. So for someone just starting in real estate, Nick, let's talk about what would be your top 3 pieces of advice to ensure long-term success.
I love this. So when I started in real estate, I had to beg and negotiate to work with a big player for free. Okay. That's my entry level into real estate, because it was post 2008. I literally offered to work for free for the family office, and they're like, absolutely not. We actually can't afford
we don't even want you for free.
We actually can't afford you because we can't afford to train you. We're firing team people. We're firing 10-year team members all over the place. We can't even support our staff. We don't have time to train you. So I had to negotiate and really make them money before I was even hired. So if someone was entering in, but it was the best investment I ever made, was to work with people that were so much more advanced, so much more seasoned. much older, much more experienced at really high level thinking and strategies. That has paid off significantly. So I get the benefit of standing on the shoulders of giants with everything that we do today. So if somebody was starting off today, I'd say the biggest decision is you have to pick a path. You have to pick one of two lanes. The first is, do you want to do it yourself? Right? Do you want to be the landlord, or do you want to invest with a group? Historically, what that used to mean is if you did it yourself, you got higher returns. And if you invested with someone else, you got lower returns. That was usually what that meant. I
Right.
think the market has shifted a lot. I would say that's not on the table as much anymore. I'd say at least 50% of the time, you will make more by being a passive investor than an active investor today. Because if you look at just things like appreciation or cash flow on assets, usually they're below what many funds are paying out.
Right.
And, there's a lot of reasons for that. I started in acquisitions. So we were buying things 30, 40, 50% off market, right? So if the market was, a $10 million property, we were paying $5.
Right.
So a lot of meat on that bone, but I had been doing it forever and my partners had been doing it for even longer, right? So that's the first is, do you want to do it yourself and build a big portfolio slowly and, work your way up and do all that? Or is your goal to invest in real estate, but not run a full-time company and a full-time job? Both have huge advantages and disadvantages, right? The next is to figure out what asset classes you want to be doing and why. I would say personally for me, I wanted to go towards commercial real estate. There was just more zeros, right?
Right.
I wanted to do things at scale. I thought there were big opportunities to do it. And with all the new technology that had been entering the market and is still today, there's huge, huge, huge data opportunities to really understand markets and understand opportunities. And then so first is, do you want to do it yourself or invest with someone else?
Yep.
The second is, what do you think are the biggest drivers? What are the biggest opportunities? What kind of real estate do you want to invest in? And then the third, at the end of the day, is how long do you want to be involved in investments? What's your goal for it? So if you want to be, hey, I want to squeeze out the best returns, you might be like a 5-year investor on deals and be looking for opportunities with quicker turnarounds. Or you might want to build a portfolio forever and own everything forever and do all the work and be full-time real estate as a landlord. Those are very different things. So I think it's know thyself on those 3 items and really being able to drill down on how active, where you want to be active, and for how long you want to be active.
Juicy. So if you could change one thing about the real estate industry, what would you change and why?
Oh, shoot. In my journey, it would have been understanding economics more deeply early on. That's what I would have done. As an industry-wide note, I would say, I think it works itself out. I'll just say that. So the great players, it's like kind of the winners win and the not winners not win, right?
Yeah.
So in the tough times, a lot of people really take their lumps, right? I took my lumps. Thank God we've never lost money on a deal. My lumps instead were like 15-hour work days and negotiating, very difficult leases and tough markets and cold calling 500 people a day. Those were more my lumps that I was taking, but we basically refused to. we tried to muscle our way into not losing money on deals, and that's how we did it. But
Yeah.
sometimes the market is so much more powerful than the entrepreneur.
Yeah.
And we almost had deals go sideways because we didn't understand the broader economy and the local economy as well as we could have.
Yeah. I just want you to knock on wood behind you. So you
Oh, trust me. Trust me.
knock on that wood, knock on that wood. They were not lost.
I can tell you the horror stories of the almosts, and those are scary enough that I have whiplash over those still. So
Ooh, me too. Me too, my friend. Me too.
Mhm.
So let's see, looking back at your career, what legacy do you want to leave in this marketplace?
I would like to leave a legacy in a few ways. The first is I want to have my reputation means a lot. Our company's reputation means so much. So we work with people that we will ongoingly say no to investors if they just don't meet the profile that we're looking for. And we hope they say no to us if we don't meet the profile that they're looking for. So it
Mhm.
has to be this very high win-win. Thank God we have a lot of, evangelist investors that are very happy. We try to over communicate and be all those things. So that's the legacy as far as real estate's concerned, is to just be a fantastic operator that give our investors an opportunity to go do the best things in their lives. As far as what that means for us, we try to invest in legacy in two ways, and we're leaning more into that now. The first is a legacy directly with the company. We buy mortgages that are basically more or less in default. So they're for borrowers that maybe missed 4, 5, 6 payments during COVID, for instance, because they got furloughed. So the legacy we'd like to leave there is to be getting in touch with the homeowners and saying, look, I'd like to keep you in your home. How do we keep you in your home? What's stopping you from making these payments? Right. Very often they go, look, I got a new job. I'm making less than I was. I used to be able to afford $2,000. I can only afford $1,300 now. And we say, okay, if we extend the mortgage, we do this, we expand your payments this way. Can that work for you if you're paying that $1,300 a month? Yes, great. Now they get to keep that 45% on average equity that they have in their home. That is great. I hate foreclosing. I was on the other side of that. I bought a lot of foreclosures in the past. I didn't always love those deals. They can be very messy and they don't make me feel good sometimes, right?
Yeah.
So that's one. The second legacy is entrepreneurial education.
Mhm.
I think we have failed on giving that to the average American, a good route for just business basics. It's all
Yeah.
over the internet. Your podcast, YouTube, you have amazing things to find that. But that's what we're looking into now. And that's kind of our bigger focus. There's a few groups that provide free classes that, we're working through donations to and structures to kind of benefit those. But the future of the US, it's small businesses are the backbone. You look
Yeah.
at post-COVID, how many businesses went down in the US, how many small businesses were lost. That's a huge concern that I have in the next 10 to 20 years, not just for the economy, but for the, entrepreneurial mindset of Americans in general. So that's what we're trying to invest in the next, handful of years.
Delicious. What's one question you wish I would have asked you, Nick?
Oh, ooh. That's a good one. Let me think about this. Okay. Okay, I got one for you. You ready?
Yes.
This is something I was thinking through this morning. I was kind of taking notes on imposter syndrome. Okay. I hear a lot of investors, or excuse me, I hear a lot of entrepreneurs talk about imposter syndrome a lot. This
Yeah.
is something I've kicked around. I'm part of every freaking entrepreneur group, EO, YPO, all these different groups that are, an entire group of entrepreneurs. And I hear, how do you deal with imposter syndrome? Strategies with imposter syndrome. I haven't had this issue. I don't internalize imposter syndrome the same way. So I'm trying to get in the mindset and think through it. This is my thought on the imposter syndrome thing that early entrepreneurs and early investors deal with. I think they internalize the feelings and the anxiety with doing something new with I shouldn't be here. Right.
Mhm.
So it's for instance, an individual feeling like I'm swimming into deeper waters than I'm used to. I shouldn't be here. I need to turn around. I'm not one of those big fish that need to be in this depth of the ocean. There's bigger sharks. Right. I think that that's actually just a misinterpretation of the feelings that people work through on the entrepreneurial side. I think in my life, it's been the biggest indication of you're actually closer to the cheese, you're actually closer to the opportunity. And that discomfort is your body saying, I'm outside of my comfort zone, which is a good thing. Because the reality is, I think if you stick around the same people and the same environment and the same stimulus that you're used to, so you never feel like you're a little outside your depth or an imposter, another way to say that, then what you actually end up with is a lack of success. And so if you look at the trajectory of people that are willing to push their own boundaries and willing to step outside of their comfort zone consistently into deeper and deeper waters, I think that you just see them take off over the longer period of time. And so for newer entrepreneurs or entrepreneurs who are feeling a little stuck, I think a lot of times it goes back to discussions that stem from, a misinterpretation of imposter syndrome. So that's something I've been really working through with, I have a couple friends that ask questions or will ping me on things. And I've gotten this lately, and I'm just like, I just don't think that's a real thing in the way that they're asking about it. So, I don't know, still working through the idea, but that's something that's really been on my mind lately, as it's actually one of the most necessary things that you actually need a degree of feeling outside your comfort zone and where your surroundings and your peers are better than you. You need that. It's not a reflection of you not being good enough.
Well, I love that because, we grew up with fake it till you make it. And then I realized as you grow a business, every zero brings new challenges and you don't know, right? If you know everything, you're not playing big enough. So we always say the bigger you play, the bigger the breakdown. So if you're not having breakdown, you're not playing big enough. So that there is always that you're going to be in the I don't know because you're playing bigger. So you can't predict it. You can have your plan, you can have your strategy, and then life happens, business happens, clients happen, economy happens, presidential elections happen, agree or disagree, or we won't get into that conversation, but it all affects us, the entrepreneur. And I, like you, agree that we are the foundation of this country, right? We are the backbone. There's still so many of us. And that's why we love where we live, is we can just decide, I want to be a real estate investment. I want to learn this skill. I want to sell this skill, right? Which is delicious. So, Nic, this conversation has been nothing but enlightening. It's juicy. Your journey, your insights, your strategies, not only giving us a glimpse into the mind of a successful real estate investor, but also provide actionable takeaways for our listeners who are eager to elevate their own venture, right? Thank you for sharing your expertise, your wisdom with us for today. For everyone tuning in, if you're inspired by Nic's approach and you want to learn more, make sure you follow him and check out SAIT Investment Group. Until next time, keep pushing those boundaries, stay curious, and always keep building your legacy. Thank you for listening. If you know somebody needs this conversation from Nic, please post it on your social media. Please email it to them. Please forward it to them, right? Entrepreneurs survive from the word of mouth, right? That referral of, oh my God, Nic is amazing. And that's why I wanted to have Nic on the show, because Nic is amazing. It's another way to build our wealth, right? Wealth is all around you. It's our birthright. It's not for some of us, it's for all of us. Nic, thank you for tapping into this conversation. And I look forward to playing with you more, hearing more about you, and helping our clients achieve their financial dreams.
Thank you for joining us for this episode of Power Your Profits podcast. Let these building blocks from today's most successful industry leaders equip you with the necessary resources and tools to finally establish the highly profitable business of your dreams. Want to hear more? Listen to more episodes at www.poweryourprofitspodcast.com. And don't forget to subscribe to the show. Now is your time to rise to the top of your game. So be sure to catch our next episode. Until next time.